who's going to be one of our affiliate members, Christian Schiotz, who is a mortgage broker with the lending team. Thanks, Christian.
Hello, everyone. Welcome. Thank you for joining us today. And I have two hats on today. I have Ralph's hat as the first-time homebuyer presentation. I also have some information in there about how to streamline and make the process a little bit more efficient for you. And then I have a presentation as well on out-of-the-box lending, all types of non-QM and bank statement programs, debt service, a lot of other things that I'll get into for you in the second part of the presentation. So let me just share the presentation with you and just ask any questions that you may have, and I'd be happy to go through those with you. All right. So we're going to start with the presentation here on first-time home buyers, fast and efficient here. All right. So to give you a little overview about who I am, I've been in the lending business for 19 years. I've helped around 2,500 clients, a lot of repeat clients, even generational clients. I've helped first-time home buyers that bought their first house, all the way up to a client that owns 600 properties currently. I've been a top originator. Some of the partners, I've been ranked in the top in the country, the top in Pennsylvania. In August, just for example, I get rated every month. I had a approval to clear to close in 5 business days, and some of those were first-time home buyers. So I can show you how to have a very easy transaction. The best part is to have an easy process. All right. So what I like to go over here is the type of mortgages that are out there, just an overview, the process to get pre-approved, credit score and understanding credit score is a little bit better. There's a lot of information there. And I teach you how to maximize your score, understanding down payment and closing costs, and then some down payment assistance. And we actually have a special guest that can go into some down payment assistance even more than I can. So let's start with the type of mortgages. I like to categorize mortgages typically into 3 categories. You have government, conventional, and everything else. So the government is FHA, which is the Federal Housing Administration. Now you can typically only have one of those at a time. There are special situations that you can have more than one, but there's criteria that goes into that. The VA loan is for veterans and the veterans' family. The FHA and VA loans are assumable if the person qualifies. We can go into what that means later. And the USDA is a kind of government loan, but it's not an official government loan, but it's a government sponsored type of loan. In the conventional world, when you hear the term conventional, that means Fannie Mae and Freddie Mac. Those are conventional style guidelines, and they're just a set of rules that people follow, all the banks follow to make those loans possible. Now, the everything else, and this is some of the things that we're going to touch base in the second presentation, are jumbo loans. So a $5 million house, using bank statements as income, all the banks that do portfolio loans, debt service ratio, and I'll go through what that means in the second presentation, large multifamily properties, so apartment buildings, 10 families, and larger, commercial properties, if you close with an LLC or a business name, mixed use property, construction loans, they all fall into that everything else category. All right. So getting pre-approved. Obviously, a person should start the process by speaking with a loan officer, either a mortgage broker or a banker, but talk to somebody in the area before you look for a house. If they're self-employed, it's generally advised that they give a few extra days because it's good to review some of their documentation to calculate their income. It's a little bit more complicated, and we'll go through income in a moment. And the more time that they have up front, if there's something wrong on their credit, they have the ability to fix it. Okay. There's 3 criteria that every mortgage in the country looks at on the buyer side to get somebody pre-approved. That is their assets. So where's the money coming from? The down payment and closing, right? And there's a lot of sources there that they can get the money from. Credit. We look at their credit. You can actually now start, or I can start with a soft check on a credit report, but we look at their credit to get them started. The income, and the documentation of how they prove their income. Okay. Now, the last part, and it'll vary depending on the house, are the property taxes, the homeowner's insurance, the homeowner's dues, the homeowner's insurance, and possibly flood. All right. So determining when a client wants to move forward, they should determine what their budget is for a property. No matter what the bank says that you're approved for, you have to have a comfortable payment. The client's going to be making that payment every month. If someone gave you more money than you were comfortable to carry, it wouldn't be advised to borrow that much. All right. So the client should always look at what their income is, what bills they have, where they're getting the money from, and a lot of other features. So they move farther away from their job, they should take the location of the property into consideration for travel. Okay. Down payment and closing. These two pieces are put together when a lender puts together an estimate. All right. So the down payment is a percentage. Banks always look at a percentage of the money put down on a home. So we would determine whether the money is coming from them, if the money is a gift. There's certain requirements depending on the type of loan that they're using, who can give a gift and who can't. So we have to make sure that the person has the relationship to give a gift into the closing. Now, the down payment can go anywhere from 0% down with something like a USDA, the Rural Housing Program, to 25% or more, depending on the program. If it goes into jumbo or a non-owner occupied property, they typically go to 25%. Okay. If the money that's being used for closing is being pulled from like a 401k or other type of investments, it's generally recommended that the client find out how long that process is, because that can take 1 to 2 weeks for the money to be transferred. It's not as quick as just hitting money on, a cash application. All right, to be put towards closing. Now the closing costs, and these are going to vary depending on the loan, the mortgage company that the client goes to, and the type of program that they use. So that would be, it's broken down into lender's fees, the title fees. So in title fees, it's the lender's title policy, the searches, the notary, all those pieces are put into that. You have the escrow. So escrow is the lender paying your taxes and insurance. You have which is optional on some programs. You have the recording fee for the deed and the mortgage, the Pennsylvania transfer tax, which is typically split between the buyer and the seller. You have the prepaids. So the prepaids are a little different than the escrow. The prepaids are money due within 60 days of closing, required to be paid for by the title company. So we have to consider that even if they don't escrow, there's still money due back and forth on that. All right. And then other costs in closing would be possibly home inspections, any kind of conveyancing fees, other real estate commissions, which is obviously a new topic today that we haven't got into yet. But there could be other things in closing here. All right. So both of those things put together are what determine a person's total needed to close. All right. Improving and maintaining your credit score. So this is one of the things that clients can improve the most. And even if you don't want to borrow any money, understanding credit will get you one step ahead. All right. So you can get a free copy of your credit report, which is at annualcreditreport.com. You can get it every year for free. And I'm going to go through here how to improve your score. All right. So let me go. I want to show you there's a lot of confusion on credit scores. So there's two main agencies that look at credit. One is the Vantage credit score, and that's the one that people get on Credit Karma. So if anybody ever tells you my credit score is 900, they're looking at Credit Karma. Okay. That is not what we use in lending today. Now, the government did talk about changing it, but it hasn't went into place yet. Okay. So we look at the FICO score. Now, there are situations where they can have their FICO score go up and Vantage go down, because if you can see here, the amount owed and the payment history, those are the two major factors in FICO. And there's a little bit of a difference here on the Vantage side. So we just need to make sure that we're focusing on the right calculation, the right matrix. So I have some recommendations here. Obviously, pay the bills on time, keep the balances low. With the FICO score, do not close old cards. So if you have an old card from the store you haven't used in 10 years, maybe lock the card so it's not used, just to protect your credit, but don't close it while you're buying a house. It can affect your score. And limit opening new cards. So you can go to that previous website and get your credit for free. I personally recommend you can use the Experian app. You can get a free account. You can look at your FICO. You don't have to pay for the paid version, and you can monitor your credit on a regular basis there. And obviously, I don't recommend using Credit Karma because it's the wrong type of score. Okay, and the link will be in the slideshow here. Myfico.com. I'm going to show you how many FICO scores you have here. All right. So FICO scores. There are a ton of FICO scores. Okay. In mortgage lending, if you see near the bottom of the page here, we use FICO 2, 5, and 4. Most people, there's 10 FICO scores, like a score number. Every mortgage in the country uses this score. That way, all mortgages look the same when they're analyzed. As far as a loan from 10 years ago or 20 years ago, use the same FICO score version that we use today. Okay. Typically on a credit card, you'll see FICO 8 or 9. That's why when a client even sees their FICO score, they could see a different score than we use. All right. But you can direct clients to myfico.com and they can see this in the education. All right. Income documentation, right? This is there's a few parts that affect somebody's approval. The income and documenting their income. Okay. Now there's two major types of people who work for someone and work for themselves. So typically, if you're employed, we look at your pay stubs and your W-2s. Now, here's what lenders look at and underwriting looks at when they analyze it. If somebody is a salaried employee, it's very simple and easy. The income calculation is straight salary. If somebody has an hourly wage or a variable hours, such as people maybe in the medical field where they have different hours, day and night, we look at what that average is. We also would average overtime. So if somebody moved forward, was buying a house, we recommend that they keep things on pace. Okay. If they worked a lot of overtime for the past 2 years and they stopped doing it now, it would affect their calculation on how they could buy a home. Okay. Now let's go on to the self-employed side. The self-employed side, we would analyze somebody's adjusted gross income. So it's not their sale number, it's what they pay taxes on. It's that bottom line number. And then we can add in certain things such as depreciation. That's why a lot of people that move forward to buy a house and get pre-approved, they say they made X number, and then they have a lot of deductions that their CPA took afterwards. That's why it's important to have those documents reviewed in advance. If a lender uses the wrong number up front, it'll come out later. It always does. Okay. So how do those two things be put together? So we have what they call a debt to income ratio. So that is how much you make and how much your payments are. In lending, we have a front ratio, which is the house by itself, and there's limitations on that number. And then we have a back ratio. So the back ratio is any car payments, any credit cards, any student loans, even the loans that aren't in repayment right now, we have to calculate something on. And we look at those ratios to get somebody pre-approved. All right. Certain things that most people might not consider that we can either add to your income or we take away from your income are possibly child support, alimony, those type of things. And just the way most of the lending programs work, we have to have 3 years continuation on a line of income. So if a child was going to lose the child support within 3 years, there would be a limitation on using it. And the same thing with alimony. If you were losing it in a period of time in the documentation, there might be a limitation on using it or not using it. All right. All right. So here's some of the variables that we look at. When somebody's pre-approved for a number, here's things to look at when a buyer comes with a pre-approval letter. Okay, and that's going to be the property taxes. Make sure that the lender used an accurate taxes for that property, right? So if you saw a house and they had 5,000 in taxes and you went to a house at 9,000, the client might not be approved if they were close to their limit. Okay. If a property had expensive homeowners insurance because the property had prior damage or the client, had a lot of claims, that can vary. Also, if the property had flood insurance, it will obviously add to the monthly payment and could affect somebody's ability to buy the house. Okay. The homeowners association, if it was a planned unit development, a PUD, or a condo, those dues would limit somebody's ability to buy a house if they're at their max. Okay. And then some of the programs, such as the USDA, are geographically limited. So a lot of Bucks County does qualify, but it's not conducive of the entire area. All right. Including in that are some of the condo communities are not FHA approved. So there's a list, and it'll be on the slideshow here that you can look at later and keep it for reference. All right. Now we're going to get into some of the programs. Now, not all lenders offer these programs because they have to be signed up and approved to offer some of these programs. This is the Pennsylvania. This is using a down payment assistance program. This is Pennsylvania's first-time homebuyer programs for this year. Okay. Now these programs cover closing and down payment. Okay. They use them. You can use them to buy the house. And they do limit the debt to income ratio. So you might be approved for more without it than you are with it, just because they have their own rules and guidelines on how we can use these programs. All right. Now, eligibility. So there's limitations on how much money you have. They're not going to give somebody with a ton of money more money to buy the house. So there's a limitation here of $50,000. So they don't let somebody who has $1 million in the bank get this money to use to buy the house. All right. There are income limits. Now they vary for some of these programs on how much the house can be. So the latest listing that I saw yesterday, the purchase price can't be over $539,200 for the main program. And then you have income limits based off of the size of your household. So it's not the people on the loan, but it's the amount of people in your home. And that in Bucks County, a 1 to 2 person household was $114,400, and it goes up as you have more people. You have to have this as your primary residence. There are credit score requirements and education requirements. Now the minimum credit score is 660, but there's special requirements if you're below 680 to do education in person. All right. Now here's an overview of some of the programs. We have the Pennsylvania State Grant, which gives you $500 towards closing. An important point on that, if a client uses that, is it does not have to be repaid. Okay. Some of the other programs do have repayment, and that's what I want to touch on today, is knowing how those programs work and the fact that some of those programs could affect somebody's ability to refinance or sell the house in the future. Okay. You have the Keystone Advantage Assistance Loan Program. That gives clients up to $6,000 or 4% of the sale price of the house. And it is repaid monthly at 0% interest, but it is repaid. So it's not free money, it's money that is repaid over time. Okay. You have the Keystone Forgivable 10-year loan program. So that's up to 5% of the house. And all these have different income limits from what I saw. It's a second mortgage on the house, and it's forgiven over a period of 10 years. So if you were to have a client and they sold the house within 10 years, they would have to repay the unforgiven portion of that money for closing. Okay. There's another program here that'll give you up to $10,000 in money, the Homestead Down Payment Closing Assistance Program. And it's a no interest second mortgage, and they do 20% per year. And again, this one gives you the most amount of money, but there's geographic restrictions, and there are also income restrictions, and their income restrictions are a little bit lower. From what I saw, I believe it was only available in Bristol currently, and it's around $50,000 a year. So it's about half of the standard grant program. Okay, so you need to know those programs, because if a client's approved for that and they look outside of that area, they might not have that ability to use that program. All right. There's a program available for persons with disabilities, and they can give them up to $15,000 to renovate the house when they move and close. And obviously they have to be qualified for that. There is an employer assistance housing program. Now, it is not required to use the PHFA mortgage, but the employer can give them money towards closing. And there's going to be a list of employers. Typically, a lot of the people on that list are hospitals and universities. So if you think you have somebody that's a hospital or university, look at the list, because they might qualify for that money from their employer. All right. Now, and we have a special guest with us, Sherry, today. We have the Bucks County program. Okay. Now, the Bucks County program can give up to $10,000. I have the income chart from one person in the house to 8 people in the house. It is a down payment assistance program through the county, and is repayable. Just one thing to note, is repayable when the house is sold or transferred, right? So if you had somebody to use this year and they're going to try to sell the house in a year or 2 years from now, just make sure that when you go to list the house or you speak with them again, they do have to understand that this money has to be repaid in the future. All right. So it does help somebody buy a home and gain equity, but it is paid back in the future. All right. And there's education, involved in that as well. All right. I want to give a couple tips on how to have a fast and easy closing. Okay. Again, I've done a lot of closings in 2 weeks, which is very fast in the industry. Make sure your hours are steady. Stay at the same company. Don't quit your job a week before you buy the new house. It just makes the process harder. If you don't have your W-2s or pay stubs, be able to get access to that. So if you don't have access to your payroll system, get a new login before you find your dream house. Okay. Credit. Don't miss any payments on your credit cards. Don't max out a credit card while you're buying a house. Don't open a new credit card. So if you're at Kohl's or another store and they offer you $10 off, it might not be worth it. Okay. Don't open new credit cards during the process. Limit the amount of credit inquiries. Now, FICO does say you're allowed to have inquiries for a mortgage. It's just not good to have too many inquiries. All right. The money that you're going to be using for closing, if you have the money all yourself, move the money into one account. Don't have 20 accounts with the money spread out in them. Try to put the money, we look at a 2-month window. So if you transfer the money in while you're searching for a house into the best income-based account you can, that will be the easiest process. It'll be the least amount of documentation. All right. And don't put cash. Cash is a very unique thing. Putting cash in the bank, there are abilities to put cash in the bank, but it has to be documented. All right. If you can, find a house that is in working order, fully functional. So a house that would have things that aren't fixed. Make sure that it's appraised after they're fixed, not the day before they're fixed. All right. Here's some of the websites, and we're going to add a couple more for Bucks County. Now, do we have any questions?
We do not. There was one question from Susan, and Sherry was able to answer about who is considered a first-time home buyer. And that's it.
Perfect. And Sherry, do you want to add anything too? Okay.
I do not. I just want to say that was a fabulous presentation. I think you covered everything succinctly and perfectly, really. The only thing I would maybe add is that for PHFA, you did say for the employer, you don't have to use a PHFA loan, but by default for the others, you do.
Right. Okay. Right.
That's what, it was great.
Thank you. All right. If we don't have any questions, we're going to move on to the second presentation. And the second part of the presentation goes into a little bit of more detail on some out-of-the-box lending, which will really help you have the ability to find more buyers and approval. All right. Give me 1 second here. Right. There we go. Okay, so I'm going to go through, there's a lot of talk in the industry today about non-QM, out-of-the-box lending. There's a lot of terms for it. And I'm going to go through it on an overview. I do a lot of these transactions, so I can help you understand what they're good for, who to suggest them to, and who you might have talked to over the past couple of years that wanted to buy a piece of property that could not qualify. All right. All right. So a non-qualified mortgage, again, they're becoming more popular in the past couple of years. Everybody's situation is a little bit different. So these help borrowers go to a bigger loan amount. If you had a credit situation, so a credit event is like a bankruptcy or foreclosure, you had something happen in your past, these can have shorter time windows on those. They allow you to document your income with other sources other than what is in the normal window. So these are beneficial to a lot of clients, okay? And again, they don't meet Fannie Mae, the FHA, or what they consider conventional qualifications. In 2022, this business doubled in production. As the banks had a little bit of a window. It was scaling up into COVID, into 2020, when the banks had a problem with COVID and some of the lending. Some of these programs were paused, and now they've come back and they're stronger than ever. All right. So here are some of the people who can benefit from some of these programs. If you're self-employed, if you're a real estate investor, if you make most of your money on commission, if you own a business or multiple business, maybe you don't run it, but you own it, you have a large net worth and you want to buy property with your assets, you don't report assets, and again, with a credit event. All right. So I like to look at the pros and cons of these type of mortgages. Obviously, the benefit is more people qualify. Depending on the program, you need a lot less documentation. So for example, my client that owns 600 properties, that's a lot of documentation if you went and documented every property. If we just do this a different way, there's almost no documentation, just the property. You can close in a business name, such as an LLC or a corporation name, but you typically can't do with most normal mortgages. You can own almost an unlimited amount of properties. So in the conventional world, you can own up to 10 properties. Certain lenders allow less than that. In this transaction, you can own 20, 30, 40 properties, and that's more normal. Okay. You can use alternative income. You can avoid the waiting periods for bankruptcy or foreclosure. They do allow gifts on investment properties. In the conventional world, obviously FHA is not for investment properties, but in the conventional loans, do not allow gifts on investment properties. All right. There's obviously a downside here. The downside is the rates are higher than conventional. Okay. The loan terms typically aren't as flexible, so they don't offer as many choices. It's typically one or two options. Okay. The costs are typically a little bit higher. So most of these loans have a cost to take the loan out. And depending on if it's an owner-occupied or non-owner-occupied, non-owner-occupied properties typically have a prepayment penalty. Okay. So let's go through, and I'm going to go through these. I included one that people might hear about that's not in Pennsylvania, just so you're aware of it. Here's the type of programs we're talking about. We're talking about bank statement programs, debt service ratio programs, gross sales or profit and loss documentation for programs, asset depletion, and also goes into asset pledge a little bit. And I'll go through each of these separately. Buying rental property and flipping it, so short-term flips, foreign nationals and people with an I-10, and the requirement for those, condos that are not warrantable, mixed-use properties, unique property types fit into here. Okay, and then there is a no ratio, no doc program. You'll probably hear about it or see it. Due to Pennsylvania state laws on ability to repay, it is not allowed in the state of Pennsylvania. Okay, so if you hear about it, It is out there. You know, we do quite a bit of them, but they're not allowed in the state of Pennsylvania. Okay. All right. So bank statement. Tom Cruise, show me the money. Okay. We physically look at someone's deposits into their account and personal or business account. There are a couple programs that do 6 months. Most of them are between 12 and 24 months bank statements. And we look at their actual deposits. If it's a business account, we look at how much they own, and we typically take half of it off as expenses. We can go less than that if it's verified by a CPA, depending on the person's business. So this is very good for a business owner, somebody, a realtor, entrepreneurs that have deposits, people who work a lot of consultants that have a lot of different types of employers that maybe take a lot of deductions. We physically see their money, we see what they make, and that gives us the ability to show that they can pay the loan back. All right. Let's go on to debt service ratio. Okay. What is this debt service ratio program? Debt service coverage ratio. This is very popular. It's mainly used or almost only used for non-owner occupied properties. This is the commercial way. When you do a commercial property, this is the commercial way of analyzing a property's income. Okay. What this means is that we take the property's income versus the property's expenses. So when you typically buy a house that you're going to live in, we look at how much you personally make to how much you can carry in payment. The DSCR programs say a property makes this much money. Here's how much the property can carry in mortgage. Now, what that means is that a property that brings in less income will qualify for less mortgage. So somebody would need more down payment because the property doesn't have the income. Okay. Now, you don't have to be at 1-to-1. They consider 1.0, which means the property would, for example, would make $1,000 for $1,000 in payment. The best rates in this type of program or where the property would make 1.25, so $1,250 per thousand or more. You can go as low as typically 0.75 or 0.8, most of these programs, which mean that the property could lose money when you're buying it and still use this program to qualify with obviously a larger down payment, and it would affect the interest rate. Okay. So the property's income does not take into account the management fees, maintenance, utilities, vacancy. We're looking at the property, the mortgage, the taxes, insurance, and homeowners association. That is what we're using to qualify. All right. So this is really good for investors that don't want to use their tax returns to qualify, that don't want to bring their income into the equation. These typically require 620 and above. You'd want to typically be around 700 to get the best terms. And these are higher interest rates because they're closer to a commercial loan. We can only use these on a non-occupied home, and they typically have prepayment penalties because of that. All right, now we'll go on to sort of an expansion of the bank statement program, which is gross sales. There are some places that use gross sales or profit and loss. So gross sales is simply going to be the top line number on your tax returns. Some people take a calculation on that. It's similar, but not exactly the same as a bank statement loan program. You would use tax returns, but they have their own way of qualifying. Typically with those programs, you have to be self-employed a year. They want you to see that you're in the same line of work for more than a year. And this is for people who have a cash deposits or other deposits, such as clients that might be paid on Venmo or PayPal or other sources where they're not depositing the money through a bank statement, right? So they don't necessarily have to bring that money through a bank statement, but they're declaring it on their taxes, okay? The profit and loss program, you have a CPA, it's an unaudited, but they prepare a profit and loss on a business and verify ownership for income qualification. Okay, here's one that's very effective: asset depletion and an asset pledge. So asset depletion essentially says if a client has X amount of money in the bank Every lender is a little different. In the conventional lending, if somebody were to buy a house and they had $1 million in the bank to buy a $200,000 house, we look at their income monthly. If their assets, the amount of money that they had, wasn't earning income on their taxes, we don't give them credit for it, because the calculation through conventional lending, you have to have their assets have to be earning income, declared income. Okay. With asset depletion, we use some of these assets, and depending on the program, it's typically between 36 and 84 months. We give somebody a calculation of that income as their assets turn into income. Okay, so you can typically use bank statements, right? Like checking savings, CDs, investment accounts, retirement accounts, money market accounts. This is very good. It's almost what they used to call like the trust fund loan, right? So if somebody has a large sum of money, but they're not taking income from it, they're not taking a monthly distribution, we can use the asset depletion program to give them income. Okay. Asset pledge is a little different. I just wanted to touch on it. It's less popular. That is where the assets are tied to the mortgage. Okay. They can still earn income and they can earn interest, but they can't be sold. If they are, then the mortgage would have to be paid down. Okay. The asset depletion is not tied to the mortgage, so it's a little bit more beneficial for somebody who wants to keep the money where it is and earn income on it. Okay. So these are really good for people who are self-employed. A lot of retirees, if you know somebody who's retired recently or plans to retire, high net worth individuals that don't show a lot of their income on the paper, these are really good programs, and they might be a better program than the bank statement program, because there's less documentation here. If you have enough assets, we can use that as income. We don't need to show a year worth of bank statements. Okay. Okay, I wanted to touch on investors that do properties that do a flip. Okay. Now there are renovation loans in the conventional world. These are a little bit different. These programs typically are done much quicker. They don't have the guidelines and the restrictions that you would have for somebody that doing a conventional loan. Conventional loans typically want a contractor to handle all the work. These, you can pick your own contractor typically after closing. Okay. And these either give you a fixed amount or a line after you close on the property to buy and renovate. So what you need to do is you need to identify the property. You need to put together a plan on the renovation cost and the timeline. These typically give you less time than a renovation loan, such as a 203K. 203K is the code for FHA's renovation. These give you a little less time than that. They're typically done quicker. And then you look at what they call after repair value. So we would typically lend on the existing structure, and we will also list on the property value when it's finished. Okay. These are, again, for investors that want to finance the property, don't want to go through a standard program. You can buy a house that is a complete shell and build it out. You typically need experience with some of these programs. That you cannot rent a home and use this typically. So this is for an investor. Okay. I-10 and foreign nationals. I wanted to touch on this, and I want to explain the difference. We're going to start with number 2, foreign nationals. That is somebody, and I've done a lot of these transactions over the years. This is somebody who permanently resides overseas. I've helped clients in Asia, Europe. So if a client lived in the United Kingdom and wanted to buy a house in the States, okay, they're not here, they don't own a business here, they don't live here. They use their credit or credit letter from their home country. They use their income or income source from their home country. They have to transfer the money here about 30 days before they close on the house. They typically need between 20 and 25% down. There are countries that are restricted, of course, due to federal law. Okay. That is for somebody who's physically overseas. Somebody who's here and I see on the bottom right here with certain types of visas, they have to have a valid visa to be here and use this program. But if they're here, they've established credit here, they have ID either here or from their home country. They have to have trade lines here in the United States for the I-10. So they can't have just moved here and used this. They have to have their taxes filed and income verified. They need a little less down payment, and they need 15% down or more, plus reserves. They have to have months of reserves after closing. So the I-10 is for somebody who's physically here. The foreign national is for somebody who's not here, or just traveling here, and they can buy property in the United States. These programs are actually, the foreign national program is a little bit easier sometimes than some of the other programs, just because they have a larger down payment and we verify their documentation internationally. Okay. I want to touch on sort of mixed use and non-warrantable condos. And I want to go through what makes a condo non-warrantable, what throws it out of the conventional boxes. Okay. We'll start with mixed use. Mixed use is where you have a retail and a residential, right? So commercial influence. It's not here on the slideshow, but the important thing to know on how that is going to be structured is what is larger. If the residential part is larger, 51%, it can be done a residential way. If the retail space is larger, it's done more of a commercial way. Okay, and that will change how the loan is done. Okay, they allow somebody to buy a building or property and live in it and run their business, or buy it as an investment property. All right, these all fall into this category depending on what the size of the property is. Okay, I want to touch on non-warrantable condos. So non-warrantable, what does that mean? We've all heard it before. If a single person owns, they do a condo questionnaire when you're buying a property that's a condo. And on that condo questionnaire, they ask a lot of questions. And if one person owns more than 10% of the units, what you'll see is some complexes that have not been transferred from a builder. And sometimes those properties that the builder retained ownership, you'll see that they own 11, 20, 25%. That would mean that the property is non-warrantable, okay? If it's been turned over to the association, right? We're not talking pre-sale, we're talking when the property is operational, okay? If you have too much commercial space, so if you had a property that had a very large percent of commercial space on a property, it could make it non-warrantable, okay? If the community is involved in litigation, right, so they're being sued, that could be non-warrantable. If a lot of the members are delinquent on dues, that will make it non-warrantable, okay? Also, if the property has a large amount of investors, okay? So you'll have some communities where it was mainly an owner-occupied community and people have moved out. It's a very good rental market. If there's too many renters in the community, it would make it non-warrantable as well. So these are things, those transactions can be done on a case-by-case basis based off of what the reason is it's non-warrantable with a program like this. All right. I know we went through a lot, and a lot of the information was pretty, complicated here on some of the non-QM. Gets very, it's a very gray area. They can do almost everything, obviously, at a premium. Do we have any questions here?
I don't see it. Sherry, was that a question you had put in about the QM, the non-QM? Okay, so Sherry had written that she's thinking the non-QM might be able to lend to folks whose income is from a medical marijuana dispensary. Is that true?
Currently, because marijuana is federally illegal, most parties do not lend to it, okay? It is a very gray area because it's allowed in the state, but it's not allowed on a federal level. The federal law always comes over the state law. I do not know of lenders currently doing that, even though they might be allowed to do it if it was a bank just in Pennsylvania. If the bank had any exposure on a federal level, I don't know of anybody doing that today. It's very complicated because of the federal versus state law.
And somebody's asking if for your contact information. Can you put it into the chat for everyone or okay?
Yeah, it's going to be in the slideshow.
Okay. Yeah, somebody wants to contact you offline, they said.
Yeah,
so.
absolutely. Whatever I can do to help, either on a new transaction or questions you have on existing. A lot of this non-QM stuff will help, put together those transactions for people who are self-employed have been told no before. Just because we go into a much wider scope. A lot of people have the income that want to buy a property somewhere, but they just don't show it in the right places for conventional.
Okay, and it looks like that is it in terms of questions. Just making sure nobody has any more before we, are you finished, Christian? Is there more?
Yeah, this is the last.
Okay, this is it. Okay.
Slide.
Okay, well, thank you so much for this fantastic presentation. It was very helpful, and this will be sent out to you and all of our members. So please share it with your colleagues. If they're not members, they're welcome to take a look at it. And you'll also receive Christian's PowerPoint. So we appreciate your time, Christian, and thank you so much to all of you for joining us today.
Right. Thank you, everyone.
Thanks. Bye-bye. Have a great day. All right.